If you ever come in contact with a bear, keep a cool head and try to stay calm. Do not yell, do not scream, don't kick or fight, make no sudden move, stand your ground, and do not try to outrun a bear. Welcome to Make Your Money Matter. I'm your host, Brad Barrett. I'm also a managing director and partner here at One Capital Management, and I'm here each and every week to help you better understand your finances because after all, your money matters. Friends, I want to share something that's probably not going to be a surprise, but what we're dealt with in 2022 and we're going to be probably dealing with in 2023 is a bill that we owe. It's a bill that is coming due, what we've dealt with over the past 2 years from the pandemic, and we've paid it partially. We paid it in volatility. We've been paying it in higher prices, inflation, supply chain issues. And there are many questions out there, like how do we look at 2023, Brad, based on the year we just had? How do we look at valuations and fundamentals in any year or year like this, or really looking at valuations of a company, let alone a stock market? Look, predicting stock values in general in 2023 is tough, largely because unprecedented actions that were done during the shutdowns pretty much leaves a wide range of possible outcomes. So I want to talk about that today. As we start the new year, I want to talk about 2023, some of the outlooks, we should say, the state of the economy, and I want to talk a little about this pesky bear market. We're going to look at all of that today. But before we do, smash that subscribe button, hit the notification bell so you don't miss a single episode. All right, let's get into it. So there's a model that's used quite often by many economists. I'm going to share one that was actually spoken about recently by a guy named Brian Westbury. He's the chief economist for a company called First Trust. I followed Brian since my college years before First Trust. And the model is called the capitalized profits model. Now, the model is a way to look at the range of where maybe the S&P 500 or the Dow Jones Industrials will look like at the end of a year or throughout a year. Now, mind you, a model is simply a predicting factor. It's not necessarily what it's going to be. It's not gospel, okay? But it takes into consideration things like the 10-year treasury note and certain actions, not just by the free market or the companies, but also by our government, something I think we should probably consider given what we've seen in the past 12 months. Now, I don't want to get too technical, but I want to start with how this model works so you can see how we're looking at things. The model takes a government measure of nationwide profits across the board from the gross domestic production report, the GDP report, and the model discounts it by the 10-year US Treasury yield, basically in order to calculate what we would consider or look at for fair value of stocks. Friends, this is where you start with a premium or a discount. What is the good price for a stock? It's not just the stock price, it's where the fundamental value lies. So this is a good, again, model to predict fair value of stocks. Not overvalued or undervalued, just fair value. So just for some context for a second, the data on this goes back to like the early 1950s. So we have almost 70 years of understanding this model and these measures, and the measure of profits, which excludes the profits earned. That's an important point. It excludes the profits earned by the Federal Reserve System. But by the way, those were up about 2% at the end of the third quarter of last year. We're still getting the data here, first week of January here. So first 2 weeks of January, we're still getting the data. And they're up also about 7.8% from a year ago. They're also further to that, up about 23% versus the pre-pandemic peak. Now, this is probably not shocking, but one interesting thing to think about is that while profits across the board, like corporate profits, while they rose about 7.8% during last year, basically, the gross domestic price index was up about 7.1%. So some context there, if you think about it. That's if you look at it, very slow growth in inflation-adjusted profits and higher interest rates combined, which is why we saw pushing stock values down in 2022. So to give a glimpse of what's happened the previous 12 months, that's how we kind of get there. Now, looking into 2023, predicting stock values is going to be somewhat tough. But let me give you a range of how this would look from an aspect of where we currently are using this model. And normally on the show, we don't get this technical, but I think in talking about a subject matter of like predicting, kind of coming off last year, where we're going to go, it was important to me to share some insight. I mean, I like doing that every week, sharing how we economists or we as us as investment advisors look at things so we can share with those watching and listening here at One Capital how we think. So again, when I'm currently using this model, using the 10-year treasury yield, which as I mentioned, it's kind of right around 3.8%. So to discount profits suggests the S&P 500 index is fairly valued using that model at right around 3,700, give or take. So context for a second, right now, we're right around a little over 3,800 on the Dow. Now, that's where you would put a fair value. So typically, you would see a trading volume around or above fair value in what you would more consider a bull market, as an example. Whereas the bear market, you might see it go down a bit more and test the bottoms, test more towards 3,700. Now, that's when you get into, we'll call it technical trading. Why am I sharing all this in the first 5 minutes this week? I'm sharing this simply to say that as we start this new year, 2023, the best advice I can give for nearly 2 decades is this: keep investing. Now, I know that's probably not shocking to many people, seeing a financial advisor saying that kind of news or that kind of a statement, but it's to understand this: we're still going to have volatility. And I've said this before, I'll say it again. It's not about timing the market, it's time in the market. Staying disciplined matters. 2 Ds: discipline, discernment. You figure out what you're investing in, who you're investing with, that's discernment, and then you stay the course. I think a lot of us right now are sharing what we all share, the new year, new you philosophy, right? We're gonna have that, I get that. Motivation is easy. I always share this dumb analogy, right? It's easy to be motivated at 9 a.m. after your first cup of coffee. It's less easy to be motivated, it's much harder at 3 p.m., okay? I know I sound like I'm being a dead horse here, but it matters. It matters because, as I mentioned before, the 2 Ds, discipline and discernment. And moreover, I share this because I think we can get really stuck in the past. Whatever context you want to look at, it's all very short term. Let me ask you something. How many inches are there between your house and the nearest grocery store? Now, you're probably, by the way, watching or listening thinking, Brad, that's kind of a ridiculous question. Of course it is. It's more appropriate to measure longer distances in miles and not inches. The same is true of investing. And we can't measure the performance of, your holdings by its daily, weekly, or quarterly fluctuations. It's way more appropriate and really more meaningful to measure it by the mile or by the year or the annual numbers. And as we look into this new year, and to make sure that we take stock, pun intended, here of the bigger vision of your plan. For this new year, your planning and really your investing should be top of mind. I know getting in shape, getting on a better diet, especially after the holidays and all the food we ate, I'm with you. I get it. But finances should be there as well. We're still going to have some volatility. We're still going to have market fluctuations here and there. That's a part of this market that we're in. And so we want to make sure that we look at the bigger picture. So we got to look at all this context, and the reality is the market and where the Fed 10-year yield is, as I mentioned on the capitalized profits model I mentioned before, this all bakes it in. And you can kind of see that we're floating right around fair market value, maybe a little bit above. So we're not heavily overweight and we're definitely not underweight. We could have some room to go if that 10-year note spikes up to 4 or 4.5%, then yeah, we can go down a little bit on the model. But remember, it's just a model. And in doing so, if you really get draconian in the modeling itself, you have to really bring the 10-year treasury note up to like 5% to even get down to a low of 3,300 on the S&P, which would be a true bottom. And that's when you really get into technical investing again. But let's say it happens. Let's just play crazy for a second, all right? It's January. Let's play crazy. Would you not want to be buying all the way down so that when you get to those positions and you get to the bottom and it starts springboarding back and you're still continuing to buy, you're actually picking up on lower assets that'll increase in value. Let's say the other side of it happens. Let's say the 3,700 fair value or the 3,900 on the S&P 500 starts increasingly going up based on maybe we don't hit a recession and the Fed can actually find a soft landing, so we don't push us into a recession kind of thing, and it keeps going up. Wouldn't you want to keep buying in both scenarios? It makes sense to be prudent with your contributions. Now, obviously, if I'm speaking to someone right now who's retired, for example, you can be doing this with your investments. You can be doing it with your dividend reinvestments. You can do what's called DRIP or dividend reinvestment programs, or hiring an active manager, someone like One Capital or a good financial advisor that helps you through all of these things to do not just dividend reinvestment programs, but maybe rebalancing and active management are all in there. Let me give you one more example. And I was thinking about this the other day, and I had to look these stats up, but I thought it was kind of interesting. Anyone who knows me knows I like sports. And I've always been a Michael Jordan and Tom Brady fan. And I know many people, they have their opinions on those people, but the reason I like understanding greatness, simply because there's a discipline around those individuals. It's a different mindset. I mean, you put Kobe Bryant there, you put in Michael Jordan and Tom Brady, you just start thinking about these guys and you're like, maybe Wayne Gretzky, there's a discipline and there's a mindset that's different that I like studying. I like studying that kind of stuff. I like relating it to your investments and my investments and to our finances. So let me give you an example of just how I think deceptive short-term performance or underperformance can be. Michael Jordan's career average with the Bulls, get this, was 31.5 points per game. Now, there was not once in his entire career that he ever scored 31.5 points in a game. Why? Well, you can't get half a basket, but I'll move on. Now, his short-term performance ranged from anywhere between 12 points against the Atlanta Hawks in the 91-92 season to the high, which was a 69-point game against the Cleveland Cavaliers in the 90-91 season. Why am I saying this to you? Short-term performance can be a poor indicator of long-term averages. If you were to write Michael Jordan off simply because he had a low point game versus the Atlanta Hawks in the 91-92 season of 12 points, I mean, if you look at the lineage there, his actual high, the 69 points that he had was actually in the season prior to that. So if you said this guy is going to go on greatness and then next year he posts a game that's got 12 points in it, you start thinking, well, maybe my investments are good. Maybe I want to trade him. Maybe I want to get rid of him. And you start thinking about this. And when you look into last year, 2022, and then into this year, you had all these gains coming in that all of a sudden you have this volatility and this downside. And you're thinking, man, should I trade this star player? I mean, should I trade these investments? You heard me say this before, but that's where actively waiting comes in. You don't want to give away a Jordan. You want to make sure you have a Jordan, right? That's where you find good managers and you find a good advisor to help you diversify and find those positions. So, you got a Jordan, you got a Pippen, you got all the guys right there in the 90s that were champions. Now, add one other spin to this, especially for my LA fans here, and myself included. Let's take the Kobe Bryant, for example. Everyone knows this, but in 2006, get this, Kobe Bryant and Kwame Brown combined for 84 points in a game. Kobe 81, Kwame Brown 3. Why am I saying it that way? Why am I sharing that? When I say it that way, it sounds like they combined for those points and you don't know how it was broken up. Your mind immediately goes to 81 points. There was two players, so maybe it was like 40 points each, something like that. But that's not the case. Make sure that you understand the context, because if someone goes out and shares with you that Kwame Brown and Kobe Bryant scored 81 points without, any more detail prior to that, you're just going to think, oh my gosh, these two players combined are amazing. When in reality, it's just Kobe. Kwame was nothing. And my analogy, that's where your investments come in. So you're going down the court. Kwame Brown was a center. Kobe Bryant was a one guard. You have your diversification right there. They're doing different positions. Kwame's not running the rock down the court. Kobe is. So they're on the same team, same goal, winning the game, winning a championship, but they're doing two different things. Your investments are the same way. You want to focus on having a full team. So as we start this year, I want to focus on a little bit in the first few minutes of the capital assets pricing model, what happened in 2022. But I want to shift gears for a second and discuss really one of the main topics that we saw last year and really for the past couple of years as we begin 2023. The state of where we are, so to speak, on housing and really the housing outlook. And I think it's important to bring this up because I think you fall into one of these three categories, right? You're either a homeowner right now who's thinking about the value of their house and how this economy is going to react to it one way or the other. You might be a first-time home buyer right now who is waiting to get in. I know a lot of clients like that and a lot of clients' children that are like that. And it's just hard. You don't know where things are going. Or maybe you're a homeowner who in the past couple of years refied, cashed out, has some cash, waiting to buy maybe a rental property or a property out of state or something like that, and are just not sure where this is going. So I wanted to pull some stats and I wanted to share with you some of the outlook for 2023. And the first thing I want to say is likely in 2023, we're going to see some house prices drop more. We should see the price drops continuing. Look, prices got too high relative to rents and need to fall more to better reflect rental values. We're expecting, and many economists out there are expecting, a total decline, peak to bottom, in the 5 to 10% range. So first and foremost, nothing like the 25% drop we saw in the Great Recession, 2006, 2011. And you might be thinking, Brad, well, why do you say that? Why a smaller drop this time around? A couple reasons. First, compared to the average of the past 40 years, home prices are already close to fair value when they're measured against construction costs. That's number one. Number two, there is right now no massive excess inventory of homes. That's very dissimilar and very unlike what we saw during the prior housing bust. And then third, and unlike during the subprime era, the vast majority of homeowners with mortgages are locked in at extremely low fixed rates, which means what? It means they'll be very reluctant to sell. And when we talk about interest rates that happened all last year, the real effect of the change in interest rates is actually evident in the existing home market, which makes sense. Some stats that I pulled here to go through that. Sales hit a 6.65 million annual rate in January of 2021, the fastest pace, by the way, since '06. But by November of 2022, about 2 months ago, sales were down to right over 4 million annual rate, which is a 38.5% decline so far. Meanwhile, a decline in pending home sales in November, a couple months ago, which goes back a few months. By the way, that's contracts on existing homes. It signals another drop that we're going to start seeing in December and into this month, January. Look, existing home buyers have two major problems. First, much higher mortgage rates, which means substantially higher monthly payments. And I nerded out on this. I had to pull some stats on this. Using a 20% down payment, the rise in mortgage rates and home prices since December, I used that number, December of 21, so a little over a year ago, amounts to a 52% increase in monthly payments on a new 30-year mortgage for the median existing home. Trip on that for a second. I mean, interest rates mean a big deal on that. So yes, if you're in that camp or you're looking to buy a house, yeah, it's more expensive. Not only is the house maybe at par where it was and it kind of got propped up, but it's just going to cost more. Now, meanwhile, it's hard to convince a current homeowner with a low fixed rate mortgage to sell. I mean, if anything, it actually makes sense for them to ask for even more money if they'd have to take out a new mortgage elsewhere at a much higher rate. So you have this disparity going on, right? You're going to have this like drop in the market a little bit, but at the same time, if a current homeowner with let's say a 3% mortgage rate were to sell, this wouldn't happen necessarily in a discussion point, but they'd be like, well, Mr. Buyer, I'll sell, but you're going to have to give me like a 20% premium because if I take that money, move because you want this house, and I don't mind moving, but I'm gonna have to go pay for another house that might be less of value now than it was a couple of years ago, but my cost of carry, my principal, interest, taxes, and insurance is all higher. I'm gonna need a premium. So you have kind of this disparity going on. I mean, in other words, sellers should now want more for their homes while buyers want to pay significantly less. There's an arbitrage. This won't change soon, by the way. And so, expect existing sales to be even weaker in 2023 than even last year. Now, that's not to be all doom and gloom. We have to let this cycle kind of go through. All right. This isn't a fix all. It's going to happen overnight. And I've shared this before, but if you line up 10 me's, 10 financial advisors, 10 investment managers, 10 economists, typically on any subject, and most times we're going to disagree because our nature of business can be somewhat subjective. But on this one thing I know to be true, if you line 10 of us up and you said, give me 2 ingredients, 2 recipes that you would build to pace inflation you've never seen before, it'd be shut the world down and print money. We did it. So we're paying the piper, if you will. But how you get through it is to actually stay disciplined. It's not to veer off course, change the overall destination. And the destination might be retirement. It might be a certain dollar amount to make sure you become financially free. Don't let something like this deter you, right? I mean, I've said this before. I love this statement and I'll always say it because it's like you don't want to let the water around you get in because that's what sinks a boat, right? Keep it out there. New home sales, speaking of that for a second, are also down, right? They're down substantially since the pandemic peak, but they, in our opinion, should find a bottom sooner. I mean, the key is that with a new home, the seller is a contractor. And also, housing has been underbuilt in the previous decade. So, I mean, the average price of a new home will likely fall, but we'll need more of them. And more houses will be likely to be put on in rental pools versus actually home ownership. So you're going to have some disparity there, but the key point takeaway there is this. We're going to see housing prices move down a little bit more because we're still having interest rates as high as they are. So that'll stave off new home sales. But we have this supply and demand issue going on, right? We still have pretty good demand relative to our supply. And until we build more houses and kind of bring the market down a little bit, or get it back to what we call ceteris paribus, like equilibrium in economics, then we'll get back to where we're at. When you add things up and you look at things right now, and every analyst is going to come out there and define what a bear market is. And the usual rule of thumb is a bear market is when an S&P 500 or a Dow Jones, one of the big indexes, goes below 20%. So we hit that last year, and we technically are hitting that right now. So let me end with this then. If you ever come in contact with a bear, keep a cool head and try to stay calm. Do not yell, do not scream, don't kick or fight, make no sudden move, stand your ground, and do not try to outrun a bear. It will only make matters worse, right? This is read from literature in states like ours in California around the awareness of coming in contact with a bear. We hit a bear market last year, in fact, and we're in it, in our investments in the stock market. The same advice is true. Stay the course, stay invested. Focus on long-term goals, look for opportunities, be wary of sudden movements. Stand your ground and try not to outrun the bear. Stay invested, stay focused, and to go through that all with an advisor, in my mind, is of utmost importance, especially as we head into 2023. So as you look at looking at what you're going to get into 2023. If you ever ask the question, hey, Brad, last year kind of was pretty volatile, kind of sucked. Are we going to see the same in 2023? We may or may not, but the reality is find good counsel, find accountability for yourself, and be able to stick to a discipline. Don't run off your motivation at the end of January like you might do with your diet or with your workouts. Stay true to your plan and have someone to help you with it. Okay, it's time to answer your questions. If you have a question or topic you'd like me to address, you can leave a comment or a question in the comment section. Or again, if it's something a bit more personal, you can just go to the About page on this channel and send us an email. As always, we keep the questions I read here anonymous, so you don't have to worry about your name being shared or anything like that, but we would love to hear from you. And the question that came in today was a perfect one, and it's a pretty simple answer. What are contribution rates for 2023? I alluded to this a little bit a week or two ago, so you can check on those episodes as well. But the 2023 retirement plan, so 401ks, 403bs, 457 plans, TSPs, they increased the contribution limit from $20,500 last year to $22,500 this year. It's actually a huge increase. Now, obviously, it's relative to inflation. So they're trying to keep up with COLA, cost of living, but that's a big increase. That's if you're under the age of 50. If you're over the age of 50, you get an extra $7,500, what's called catch-up. So you can almost defer up to $30,000 if you're over the age of 50 into your retirement plan. So it's gone up significantly. So I definitely recommend taking advantage of that. Take a look at your cash flow right now. If there's any opportunity for you to move off some debt, pay down some debt, move things over to your investment pocket for your retirement, now's the time to do it, especially with the increased limit. So great question. And again, if you have a question or comment you'd like me to read here, you can leave it in the comment section or email us in the About page on our channel. And before we go today, if you found anything helpful today and want to learn more, visit our website at onecapital.com. You can also scan the QR code on the screen with your smartphone to get you there. You can also call or text us. We want to help. Listen, there's no pressure here. We don't want to treat people like a number. We value our relationships. It's the lifeblood of what we do. So click, call, or text us today. What a better time to do it than the start of the year. Make it your priority. And if you're not following us on social media, you should be. You can follow us at Make Your Money Matter. We're sharing great information on all of our social media platforms. And as I often say, if you enjoyed the show, share it with someone you like. And if you don't like the show, I guess share it with someone you don't like. But until next week, always remember, make your money matter.